Let's, let's get started. So, at our firm, we believe that we partner with our clients and we believe that an educated client is our best client. We don't want you to just say, here, take my money and do something with it. We want you to understand what's going on. What's going on in the market, what's going on in the world. That's why we do these webinars. But we're going to try our best today to help you with your finances. We believe that knowledge is power. One of our missions is to share our knowledge with our clients and help you make better informed decisions. All right, let's keep going. Okay, if you look at these charts, you can see that first quarter was a roller coaster. So the S&P 500, the Dow Jones Investors Average, I can't even talk today. It was a roller coaster ride. We entered 2025 with a new administration, right? 2024 was a good year, but in mid-February, the markets made they were at an all-time high, but then after two robust years for equities, investor sentiment quickly did an about face. With all of the changes going on, it made people very nervous. But uncertainties and changes quickly dominated the headlines, and equities experienced a quick downfall during the last 6 weeks of the quarter. The transitional period between a new administration is typical, it always brings adjustments. And with those changes comes volatility. As promised, the United States new administration has an aggressive agenda, and President Trump's first priority was to implement quick and sweeping changes. So equities reacted to the uncertainty during the quarter by going near or into a correction, right? It was correction territory as investors became very nervous because it was way too much going on. We were looking at global trade wars and new tariffs, and how was that going to affect our economy? At the first quarter's end, the S&P was down 4.6%. Year to date, and the Dow Jones was down 1.3%, right? But let's keep in mind that the markets always reply to what's going on in the world, right? So when people are nervous and uncertain, that always causes volatility. Okay. But then we had some good news when the inflation numbers came in. It showed that the US inflation had decreased to 2.8%. That was down from 3%. So the core consumer product index, which excludes food and energy prices, is always viewed by economists as a better gauge of future inflation. The increase in shelter costs, remember, if y'all have bought a house or tried to rent a house or rent an apartment, everything is shooting through the roof. Those costs in February accounted for the fact that the consumer price index rose, right? While the inflation is gradually moving towards the 2% where the Fed wants it, we still got a ways to go at 2.8%. Okay. Last year, the Fed reduced interest rates 3 times, right? And what they were trying to do, the reducing or raising interest rates is the way that the federal government is able to keep track of inflation. Okay. And so they reduced it 3 times last year. And what they're using to decide whether or not they're going to, they're always looking at key economic indicators to decide whether or not they're going to either lower or raise interest rates. So after the first 3 times, remember they meet, every month, right? But After the first three times, they did not, you can see that they did not make any more changes. We can see in January and in March, they made no changes. They did not lower or raise interest rates. I know that people would love for them to, but that is their indicator. They're basically saying right now, they will, whether or not they lower interest rates will be contingent upon inflation trends and economic conditions. Okay. So think about bonds. It used to be where everybody said, bonds are safe. When the economy is crazy, go to bonds, right? And bonds normally have an inverse relationship to stocks, right? When interest rates go up, right, then bonds go down and vice versa. But lately they've had an inverse relationship because it hasn't been acting the way we expect it to. So think about it. If you look at this chart, it is showing that if you have a 30-year, look at March 31st of 2025, if you tie up some bonds for 30 years, the interest you're going to get on that is 4.59%. Well, if you're in retirement, that's okay. But if you're still growing your investments, you're certainly going to want more than 4.59% over a 30-year period of time. So right now, bonds have been not exactly doing what we want them to do. Okay. But listen, the current outlook for bonds in this year, it remains unclear. Uncertainty about interest rates, inflation, clarity on tariffs currently remain. People are unsure. So therefore, you can expect bond yields to keep fluctuating up and down. Okay. All right. The transitional time between a new administration always brings some uncertainty and can lead to volatility. But the new administration came in and indicated that their first agenda was to make quick and sweeping changes. So immediately investors thought, oh, this is going to be good. And, business owners were ready to spend money. And so what we saw by the second quarter, investors became very concerned, they were nervous about these global trade wars and tariffs, and it created a lot of anxiety in the market. So let's talk a little bit about tariffs because we hear it all the time. What is it? Right now, you can't even turn on the news without hearing about all day long. What we're hearing is tariff, tariff, tariff. But exactly what is it? Are they good? Are they bad? But a tariff itself does not necessarily cause volatility. It's how they're being applied and investors' reaction to what they think is going on. That is what creates instability in the market. But a tariff is simply a tax imposed on goods that are imported or exported between countries. And they are a type of trade barrier that can raise prices and reduce the availability of goods and services. So think about it like this. I'm the US, and here is, let's just say Canada. So we export a lot of food goods, a lot of things that we make in the US. And so Canada says, well, we want what y'all got, but we're gonna put a tax on it. Okay. And right now, our current administration thinks that the tariffs that other countries impose on us are higher than what we impose on them. Okay. So it has always been the case that tariffs have been used Companies that import foreign goods may pay the tariff to the government. These tariffs can be a percentage of the value of the imported product, or it can just be a flat tax. But they are used to protect domestic industries and jobs. They can also be used to punish or discourage actions a country disapproves of. So, what does that mean? It means I'm upset with China, okay? And so I'm going to say, okay, China, everything that I want y'all to think about this. If you go to the store and buy anything in this country, it is hard to find stuff that says made in the US. So many things are made in China. And so companies were encouraged to reduce your costs, send it over to China because we can get it done way cheaper over there, right? And then, so we send it over. It's a US company. We send these products over to China to get made. Now, to bring them back, we impose we impose a huge tax on it. Well, that hurts both the company that's making it, right? Because I sent it over there to get it done cheap. Now I'm having to pay a tax to bring it back. And it also means that the people in this country can pay a higher price. Eventually, we will pay higher prices. Why? Because no company can afford to absorb those higher costs without eventually passing it on to the consumer, right? All right, that makes sense? It can increase the production costs. Now, I'm going to hold my personal opinion for a minute here. All right. So, the Trump administration announced multiple tariffs, and this is what they said. They feel like we should protect our domestic industries and boost sales of America-made products. And what he specifically said is, you companies that are sending stuff over there, bring it back home and make it in America. Well, you can do that, but it's more expensive. And if I own a business, let's say I own product A, okay? And product A costs, I charge the consumer $30. And I can have all of these products made in China for $3. And then when it gets back here, I charge $30. Okay. Now, if you say to me, well, quit sending it to China and make it here. Well, I can't get anybody to work for as cheap as I can get them to work in China. So therefore, this same $30 that I'm charging, now it might cost me $15 to make the product because I'm having to pay higher salaries here. Does that make sense? So these higher salaries mean the business owner, boy, it has cut my profit in half. See? Because I was getting it for $3 and selling it for $30. Now I'm making it for $15 and selling it for $30. So if I still want to have the same profit margin, I got to raise my prices. That makes sense? All right. Well, right now, during the first quarter, these tariffs, when they were being discussed, it made the S&P 500 go into correction territory. And a correction just means anything more than 20% when the market goes down 20% or more. Okay? All right. The global equity markets went down, and we thought we were in for a long, hard ride. But as of now, the level of uncertainty is still very high. We don't know the specifics and how much these tariffs are going to affect the economy. We just don't know. And we don't know how it will affect inflation. But I can tell you that me and everybody in this office, we stay focused on and pay attention to what's going on because it's my job. I'm supposed to know what's going on, right? All right. while I understand that all of this volatility in the stock market is very, very uncomfortable, when my clients call me, I say to them, yo, we cannot, this is called market risk, right? There's all kinds of risk. This is market risk. And I say to those people that call me concerned, did your goals change? Your long-term financial goals, did they change? Well, no. Okay. And do you believe that we have diversified enough where you're still going to be okay long term? Well, yeah, I do. Well, then you got to stop listening to the news. Why do I say that? You have got to minimize. Remember, y'all, this is Juanita's opinion, okay? The news gets more listeners and more clients. Why? Because they're scaring y'all to death. So you're going to tune in when you get home. You're going to tune in before you go to bed to see what just happened. What's going on? And people will call and say, I lost $1,000 in my 401k today. Okay. Now, what I say to that is sometimes we may want to make some changes. If you are close to retirement or in retirement, you can't afford to lose 20, 30%, right? So we may make some adjustments. But for the most part, what we can control is our behavior. You know that concept of buy low and sell high? That's a real concept. But what happens is when people get nervous, like they are right now, and listen to the news, boy, if you listen to the news, you need to get in the bed, cover your head, and stay. But if you stay focused on what your long-term goals are, I promise you, you'll be okay. All right, let's keep going. All right, this chart basically is showing long-term investing pays off because you have to be unemotional. So look at the green line shows after over a 40-year period of time or a 30-year period of time or a 20-year period of time, as long as you are consistent, the market, even though it can be volatile at times, the market will do you well in the long run. Okay? Even when there's some very severe downturns, long-term investors have usually been rewarded. Okay? All right. So let's just kind of summarize here. We had two really robust years for equities. The S&P 500 entered in correction territory in the first quarter of 2025. The new administration brought a lot of changes, including these tariffs, which have been a significant impact on equities and investors' confidence, right? The Fed held the federal funds rate steady at 4.25, and as of March, they are still forecasting possible rate cuts for this year. We had better than expected inflation numbers, which came in showing that the U.S. inflation decreased to 2.8% in February. It was down from 3%, which we love. We want it to go down. And then bonds present a less volatile alternative to equities and an additional option for those looking to diversify their portfolio. Focusing on what you can control and minimizing your exposure to the news that are trying to scare you to death can help you stay well grounded in times of volatility. And then understand that market declines are always a part of the investor experience. And maintaining the consistency of a well-devised, long-term focused plan has historically served investors well. So remember, you're always going to have questions. Guess what, y'all? We're always here to answer. So what we have been doing is our first quarter reviews, calling everybody to get you on the calendar. We talk through where you are, what's going on. If you have not had your review, please call us. We have been trying to call everybody. Give us a call. We'd love to get you on the calendar, go over your specific stuff. Remember, we try to get to everybody, a review with everybody at least once a year. And some we do twice a year. Okay? I never want you to be out in the cold, just wondering, sitting there, with your teeth chattering, scared that you're not going to have enough money. Pick up the phone and call us. Okay? Give us a call at J. Stevens Wealth Management, 512-598-9080, or you can go to the website and send us a note and we'll respond immediately. Okay. I'm going to stop sharing. I hope that this was helpful. And again, if y'all have any questions whatsoever, reach out to us, 512-598-9080. And either Courtney or Angela will get you on my calendar and we can talk about whatever you want to talk about. All right. If you are in Texas, stay cool out there. It's getting hot, y'all. All right. I will see y'all the next time we do one of these. Y'all have a wonderful weekend.